Hello, ladies and gentlemen, and welcome back. Well, it's that time of year again where we find low volume. Most people are on holidays, and it's also the period in time where everyone believes the Santa Claus rally begins. Yes, that's technically the start of this week. But what happens over the next 7 trading days could have a massive impact on 2023. In fact, if Santa doesn't come and bring the Christmas cheer over the next week, it could be a really bad Q1. Let's take a look at the stats together today as we cover off on stocks, commodities, and cryptos into 2023. On top of that, we've got unfilled gaps in 3 locations, and we need to talk about each one as it helps us to get a very clear idea of what we expect over the next coming weeks. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We'll start with the macro and the key news indicators, then we'll go into the lead indicators and of course the key levels that you should be watching right now. We're also including a new segment which is expected moves based on options, which I think you'll enjoy quite a lot. And we've got that for a few stocks in today's video. So smart money versus dumb money confidence. We've used this a lot throughout 2022 to figure out switch points in the markets. And only a few weeks ago, we found that switch point where we saw basically dumb money and smart money cross over, and it was our first inkling that all may not be well. Now we're finding them kind of doing battle with each other, and this is basically inflows into the market. Who is winning, who is losing, who's actually deciding that it's a great time to be in the markets. Well, let's just take a look at 2022 in retrospect. First up, if you're following us over at FX Evolution on Twitter, links in the description down below, we're always sharing a lot of these charts and information. So we'll start off with the Nasdaq ending negative 20%. Well, it seems like it's going to do that. Of course, we've seen even bigger falls than 20%. And some of the stats are quite interesting. It looks like 50-50 on the surface towards the next year. Basically, when you have a bad year, you tend to have a 50-50% chance of getting another negative 20% plus year, or a very, very, very nice one. It doesn't look like it helps too much, but if you look at some of the years and you think about what's coinciding, 73 into 74, that was a negative. Then 74 out was, of course, a positive. 2000 was a negative into 2001. Then 2001 out was, of course, also a negative. And then we led into, of course, positive after that. So actually the stats are a little bit more geared towards the negativity side, if you get what I'm saying there, with some of these negative Nasdaq years. That's an interesting point. Now, what could give us a bit of a sign that this is actually occurring? Well, it actually could be the Santa rally. Santa rallies historically have held up very, very well. And usually you get green percentages. We've shared that over on our Twitter before, and we'll bring it up in just a few seconds. But the Santa Claus rally technically starts as of this week, and it leads into usually the first 2 days of trading in 2023. And we notice here that if the Santa Claus rally doesn't come, the stats are mind-boggling towards January and Q1 years and even calendar years being negative. It all starts potentially in the next couple of trading days. If we scroll through here and we go back down to one of the stats that we shared a little while ago, you'll notice here, these are all the Santa Claus bullish and bearish kind of stats taken now from the last 20 years. So go check that out if you're interested. Remember to follow at FX Evolution. Well, let's take a look at the year of 2022 as a comparison to the S&P 500. We know it's all about growth compression, and that probably is going to be a big thing in 2023. But at this time, it's going to be all about earnings. So watch the Q1, the Q2 earnings. Earnings are going to be a massive deal for 2023 as we probably combat inflation, but at the same time, potentially do too much damage to the economy. So negative 25% is what Apple is currently down. You'll notice it's holding very, very well. If this stock does fail, and we've got the key levels to be watching here and the key ratios in today's video, this will be kind of like the straw that breaks the camel's back. If Apple fails, you can imagine it's going to pull the Nasdaq and the S&P 500 quite a lot more. In comparison, things like Meta and of course Alphabet, Netflix and others have all been coming under a lot of punishment, and the old FANG investment of the last decade just doesn't look anywhere near as good as it used to. So what data or stats do we lead into this holiday season, and more importantly, the next couple of months? Well, we've shared 2 main data points where we have a little bit of information for it. New York Stock Exchange 52-week lows are starting to expand again. that hasn't been historically a very good signal. When we see these types of things, here are the stats. The next week, we got this reading last week, by the way, 29% of the time the market's bullish, then 25, then 33, then 33, then 42. Now, if you know anything about your stock market stats, you'll also know that markets tend to usually be positive. Well, yeah, it's not happening here. These are very negative stats, and it's not like we don't have a little bit of data. We have quite a lot all the way back from the 1920s, and you can see that the stats point towards maybe some significant weakness. One of the things that you're always looking for as an investment in 2023 when it comes to weakness is also tracking the forward PE ratios of the large cap stocks. Historically, 17 has been very fair value for US stocks in terms of forward PE. And if we get compression, expect 17 to be the number that the market tries to track. If it gets down to something like 14, well, you might want to start thinking about the old Buffett principles, because that is a big deviation move from what is historically cheap. Forward PE, I think it's going to be a very important one to be looking at moving through 2023. What about the MACD signal that we got about a month ago? Does that still bode poorly as well for markets moving forward? Well, it historically does, because 1 week, 2 weeks, even 3 months later, we have very weak stock markets when we see these types of switches. Again, we've got a decent amount of data points taken over the last 50 years, and the stats point towards themselves. If we see technical weakness and we have the data, which is something we love to see on this channel, remember we're data driven with technical analysis and psychology. This helps us get a little bit of an idea of if we see things like distribution setting up, such as what we're having right now, we need to be careful. And unfortunately, even though we're optimistic on markets moving forward, it's something that you've got to keep in the back of your mind. Conditional seasonality as well during bear market years usually don't bring the Santa cheer. We'll find out over the next week, I guess, whether there is Santa cheer or whether it's all wiped off before the close of those data stats. But this is bear market years versus traditionally probably what you're seeing on the internet a lot, which is a rallying period for markets. Remember, it's important to pull the stats that are relevant for the current time. We are in a bear market. 2022 has been one. Let's have a look at what the market movers are doing. This is what Wall Street's doing underneath the hood. Here's the last month. So December basically taken overall. And you'll notice that gold, a stagflation style play, utilities, healthcare, and consumer staples are holding up the best. The under the hood movements have been very defensive this month. That's the pension funds, the 401ks, the big hedge funds. Anyone that has to be invested in the market has said, you know what, we're either going to buy some bonds, which have been doing very well, or we're going to hold defensive stocks. They have to be invested. They can't always be in cash. And this is a huge portion of what they've been doing over the last month. If that continues through to January and we stay high in the markets, you've got to pay attention to it. Let's get into the charts now and start talking about all of the lead indicators. And then, of course, the key levels that we need to be watching, or you need to be watching out there. The VIX here is really important. The VIX, of course, the volatility index, we're dropping back down to what you would call a normalized market. Basically, 20 is considered the movement between a bull market and a bear market. Underneath 20, often people believe that it's just more of a bull market period, and above 20 is a significant kind of spike in volatility. Now, we've seen this happen many times throughout 2022, where we've come down to 20, and then all of a sudden we've seen a huge spike in negative attitudes towards the market, and then the VIX has spiked with it. We got that initial one, now it's dropped back down. It looks very similar to that kind of March into April period. It dropped up, it went up, it came back down, it found the 20 again, and then it spiked through. You'd think this week is pretty important, but definitely the next 2 weeks is going to be paramount to the markets. Watch the VIX. If it goes too much under, let's say like a 17 or an 18.5, well, we've got to start to question whether the bulls actually do have control. We just can't necessarily see it yet in price. What about bonds? What are they telling us? Well, high yield bonds have been one of the best indicators of 2022, and that's because they're junk bonds. Effectively, you wouldn't want to own them unless you feel really, really solid about the financial status of the world. High yields here, you can see, have been dropping steadily. We've had these previous readings with similar drop periods. That usually has foreshadowed bad things to come. If high yields are down and the stock market is rallying, question everything. That's something we'll be doing here on the channel, and of course, follow along for us. PCC, put call ratio, a lot of people were discussing this on the internet and getting wild on it. They were very concerned about seeing so many puts in the market because, of course, if you're a bear or you're feeling bearish in the markets, to see so many puts usually means that we can't fall because, of course, Wall Street or the composite man or whatever you want to call it doesn't want to move down while there's so much money at stake with these puts. Yeah, that's what we saw. So it kind of made us think there's a rally here, at least initially. And so far at the time of this recording and the previous ones that we've done, the rallies have started to come through. It doesn't mean they're going to hold, which we'll talk about soon with our key levels, but certainly some of these puts need to come out of the system. Watch the video because later on we'll be talking about where some of those are at. Let's look at the US dollar. How's it going? Again, we saw that pull back to these key levels. We've seen bullishness through the 104. We've seen pullbacks, and as if we get new highs here, let's say prices go through 104.30 for the DXY, we'll send a little alert. We'll bring this alert down here to above that. We have to feel that the US dollar is probably showing some mild signs of strength for now. And again, if it's rallying and the stock market's rallying at the same time, it is still a question mark about whether the US stock rally is real. Look for these little signs, these subtle hints that not everything is correct. We did see the US dollar break through a fairly significant downtrend recently, and if it makes a new high above 104.50, that's a significant deal. What's that doing to gold? Well, you can see here on the weekly how gold closed. Lots of rejection wicks. If we get new highs that go above these wicks here, and we'll set an alert together right now for it, sitting about 18.25, we have to believe that gold will rally further, most likely going towards 1870, 1880 kind of zone. This is a significant battle or war zone area between the bulls and the bears. You can really see it here through the middling ground, the dojis, the fact that there's equilibrium or there's a certain level of indecision here. Now, we did speak about the idea that we thought markets should fall around this price. And of course, we were a little bit early, this 1810. We thought the stop losses should hold above 1825. They did. It moved into a small distribution. And then we saw a massive sell-off that came through. We were not able to make a new low. And I think that's significant. There was no new low that was formed here. So basically around that price of 1783, we weren't able to go through there. So now gold traders will be looking for pretty much the rally to go maybe back into 1810 and then for it to turn around. Dollar index strength, ideally gold weakness, if that's what you're feeling from the bearish side. We do need to, of course, think about these swings and say, okay, well, each time we've generally been making a set of higher peaks. We didn't do so here, but we do still have those higher lows. So if markets breach through these highs, again, we have to expect further rallies. At this point, we're looking towards short-term time frame weakness, but we really need new lows to be formed. And of course, weakness should be happening somewhere within the next $10 to $15 an ounce for gold if that's going to occur. What about oil? Well, luckily we sniffed this problem out, didn't we? We saw that big rally wick. We saw the pressure that it was putting on this downward sloping trend line that was very good. The trend was down, and then all of a sudden the market did something very sneaky and of course broke through. Since that point, we've been bullish towards the idea of at least 82 a barrel, and that's where it's going. Do we change our ideas of eventually a 65 barrel happening? Probably not. I don't think that really changes. But at this stage, yeah, 82 a barrel seems like, 82 to 83 a barrel seems like where the market would like to stop. And at this point, it's absolutely powerhousing at the time of recording towards that area. Now we get into the one that everyone wants to talk about, which is Tesla. Yeah, look, Tesla's been very interesting. Huge amounts of selling. They haven't obviously been all Elon. Some of the big funds have clearly been selling some Tesla as well. So what I thought I'd do is I'd include the expected weekly options highs and lows for Tesla traders, so you have a bit of an idea of what the market should be doing this week. Theoretically, it shouldn't, if it was to hold within standard deviations, you wouldn't expect it to go above 130.85 or below 113.55. That's the bear and the bullish side. We're currently sitting around 123. Let's have a look at the smaller time frames though. We'll go to the 15 minute just to understand this move. So ever since it pretty much broke below 200, which certainly we've been very bearish on it. I was bearish between 135 to 123. And that's kind of where I guess it is right now. But it's probably moved to an extreme low. And the reason I say this is because so many people are, of course, talking about this market and the fact that, you know, it's looking bad or it's looking good. We'll look at the options in a second. Let's have a look at the 15-minute chart, though. So we got this low, we got a high kind of area. Then we made a lower low, and then we made a higher high. It's really now or never for Tesla. It needs to find buyers pretty much around this 123. Does it make some sense to the daily chart? Let's have a look here and zoom it out. You'll notice that the 123 is underneath this one, which is underneath the 126, which is pretty much where I thought it would go to. And then we've got this 117. Now, an extreme low would be taking these 2 points and, of course, hitting that 113 this week. But around in this middling zone, it's already taken the low. Many people's stop losses would have been sitting there. It's taken the gap. It's pressured everyone that bought at 150. And when we look at the options, which we'll do right now, it does make some sense that it might want to rally. Let's have a look at the options expiring this Friday, of course, on the 30th. We have here the 120 puts. And then, of course, we've got this significant wall sitting at 160. You can't expect it to be above or below really these levels too much by the end of the week. But you also wouldn't expect it to be getting anywhere above that 155 or even the 150. You kind of expect it to start forming base somewhere in this range. So between that kind of 120 and maybe 145 seems like a pretty fair pick based on where we're seeing the options. We obviously know that 130 something was the expected volatility. And I think it was a 7.1% move expected this week, one standard deviation. So basically 7.1% move on Tesla is expected. That's pretty volatile, pretty extreme. And if you were thinking about it, you've got to think it's towards the bull side based on the current data, even the current 15-minute trend. Hey, we'll find out. You're trying to definitely stop a freight train towards the short side, but it's starting to, did you see that 15-minute? It's better than what we've seen in the past. If you go back over here and we just go back down, you'll notice that there were no other times really where the 15-minute structured up and was able to do a similar sequence. It just couldn't do it. Every time it fell, it just kept getting owned and owned. Did it make a new higher high after a lower low over here? Absolutely not. So this is the first significant partial sequence for Tesla. Hopefully they can find some buyers. Let's move over to Apple, the big one. This is the needle in the haystack, yeah? If the market does fall below this zone, it's going to be significant, around that 130 for the stock. It's kind of forming its own little, maybe potentially little double bottom. We do have a target. We'd like to see it back to the 143, 145 area. If we go down to the smaller time frames, such as a 2 hour, you can see here a significant level to maybe price is maybe that 137. What does Apple do around there? Little gap left at 135 as well. And we have that significant one sitting around 142.50 in terms of gaps. So I wouldn't mind the Santa rally to come through, push up into here, and then hopefully we find the bears sitting around that zone. And that's at least a logical conclusion that we can make from something like an Apple stock. If we look at NVIDIA, you can't like this stock right now. That was a horrible, horrible, horrible close. Big shooting star coming off the top here at just under 190. Look, semis look pretty weak. We'll look at the semis in a second. Again, you may see rallies, but overall, that's a very weak looking chart. Let's have a look at the semiconductors. Here's the semiconductors. Anybody that knows technical analysis would probably call that a distribution. And that's the reason is because it had this false break. This is something that we picked up as a community here on the channel, and we certainly didn't like that. So the false break here, the market's moved down since that point. I wouldn't mind to see rallies into sells. And that's kind of like the way we've got to think about it. There's still a gap to be filled through a lot of these semiconductor huge moves. Semis came back very hard, kind of like a dead cat bounce, but now this distribution, we can't ignore it. Let's look at this in comparison to the markets very, very soon. XLY, consumer discretionary, again, drop and a bit of a base and then a drop again. If the market does rally, what's it going to come into? You would think selling pressure. It's not really trying to be biased. It's just the reality. If we breach a new high here, well, okay, we can question everything about whether we think the bears are in control or not, because if they manage to push low here and like this, then all of a sudden we've got to say, well, that probably was some form of maximum pain. Everybody got trapped, and now the markets are willing to have a really nice rally. So look at consumer discretionary. Very weak, new lows. This is a weekly closure. It's a significant level that was closed below. Doesn't bode well for rallies moving forward. Consumer discretionary versus, of course, staples. This is one of our favorite indicators. It shows us 1/3 of the US economy. Again, at this stage, it looks weak. Rallies, you would think, be met by sell demand. Unfortunately, some of the stats back this up that we showed in today's video. That's just the way we're looking at it. Let's have a look at the DAX. How does that look? Again, the supply over here acted as a selling point. If we do get rallies, which we kind of expect to happen, we've got to think some bears are going to be looking to sell at a point soon in the future. Look at the Dow. The Dow came off our perfect level. Pretty happy with this one. Obviously downward trend, came back tested, also support. Little wicks showed us the way. We got a wick here, rejection on the previous candle. And then of course we saw that rally through. We'd like to see new highs here. And then of course, potentially sellers coming in later on. How are we going to find where the sellers come back? I think the best one is going to be using the S&P 500. Here's the same thing again, just showing up on something like the US 100, the Nasdaq. Does look a little bit weaker, this chart. Doesn't look as strong. There's the false break to the upside, the breakthrough. We're looking for rallies. I'd like to see something like this occur later on. So hopefully that can happen. Do we see buying wicks down here? Yeah, a little bit. Buying wicks certainly coming through slightly. Let's move over to the S&P 500 because this usually gives us the best signals. So first up, we know where we've got gaps. 37.47, 38.78, which you'd think the market's going for today, hopefully, in the markets. We should see a bit of a rally through. And then the big one, 39.95-ish. So if the markets rally, could this be where the sellers come back in? Well, hear me out. Let's have a look at the US 500 here. We do know that buyers have recommitted down here. Why? Wicks. I mean, frankly, the wicks have come through. There was a big knockout kind of low that happened with that 37.60 move on the S&P 500. And then all of a sudden it's coming towards the bull side. So you could really see something like this occurring and then pushing into that 39.95 and that downward trend line. Now, at that point, we're going to have a daily level close. We're going to have a 61.8 golden fib and pocket, and we have a downward trend line, and we have a lot of reasons towards the bears potentially pressuring that area. So this will be a very important level over the next week, that 4,039.95. It's becoming better and better. And you've got to think that at least initially, potentially some Santa rallies come through. Now, bears, what are you looking for? Well, it's pretty simple. Closures underneath 37.50. You get that, you can probably have a little bear smiley face and feel pretty good about the world because it's looking pretty negative towards markets. But for now, you've got to kind of favor that rally, mostly because markets usually like to trap, and this would be a fantastic level for a lot to come through. It probably makes sense when we start looking at it. What about the options? Well, the reason the bears may not have as much fun this week has to do with the puts. I mean, I don't know who owns these puts, but they're not going to make much money, it looks like. 360 puts, just huge quantities. I mean, look at this. 256,000 units. That's a lot sitting at 360. Then 365, then 370, then 375. There's puts everywhere. 3.12. I don't even know why there's so many here for the end of the year. I guess it's got to do with taxation. But yeah, Max Payne sitting at 385, current stock price 382. I think the expected move on the SPY this week is not that much due to options. It's like 1.5 to 2% move. Might get more than that though. But this is a big one. And then of course, look out to the 20th. Take a look at this, 4.755 million. Now, this is going to be a tough time because, again, look at the puts. This is the last big put expiration that we have in 2023, and it's just massive. And again, it points towards potentially the market being in kangaroo style. Rallies followed by sells, rallies, sells, and just making sure that it expires as many of these as worthless as possible. We'll continue to follow that as you follow off on the channel. Let's move over to Bitcoin. Nice rally here. I'd hope to see the rally continue. It had a beautiful pullback right to around that zone. We hope 16.6. Now we'd like to see the market go towards 17.5, 17.6 level, somewhere around there, and then potentially find those sellers. Again, if that rallies with the market, that's good. That's what you want to see. A lot of people believe Bitcoin is front loading the market at the moment. I'm never really convinced either way on that. It's hard to figure out whether that synergy is really there or not, but a new high here on Bitcoin, of course, should be theoretically positive for growth assets for now, and you would expect some risk on in the markets moving into hopefully risk off later on. Thanks very much for watching that, because of course the news ahead, there's just not much. It's a very light news week. We end the year, we end usually on low volume, which can create a lot of volatility. And I did want to say, I hope everybody out there had a very Merry Christmas with their families. I hope everyone that doesn't celebrate that had a happy holidays or is having a good holidays. And of course, as we end up 2022, I want to say a massive thank you to each and every one of you that supported this channel, giving us thumbs up, likes, everything else like that. I will thank you quite a few times this week because it's been an amazing year and we don't take it for granted. I think it's really important to recognize that you make this community so important here. So if you've enjoyed everything, give it a thumbs up, smash that like button, and just remember that this week is low volume, particularly if you're a currency or commodities trader. I have to tell you this, look at the bid and the ask before you place trades. I really stress that, especially as of like the 30th of December into about the 5th or 10th of Jan. That period there, you do tend to see a lot of illiquidity, and sometimes you can accidentally, I'm sure someone has this comment, so if you've ever seen it, put it in the comments down below if it's happened to you, so you can warn others around it, and that is that you press a button, the bid and the ask spread are so wide that all of a sudden you're paying so much in brokerage that it blows your trade out. And this is specifically to futures traders out there. I've had it happen to me, so I'm just warning you that it can happen. Check it, double check it, make sure you know what you're doing. Thanks so much for watching. We'll see you in the next one. And of course, consider subscribing. Bye for now.